Listen, I need you to stop whatever you're doing right now. Put down that crossword puzzle. Pause that episode of whatever crime show you're watching where they solve murders using technology that doesn't actually exist. Tell your spouse you'll be back in about 20 minutes, assuming they're even listening, which after 50 plus years of marriage is statistically unlikely. Because what I'm about to explain to you isn't just another story about markets going up and down like your doctor's opinion on whether eggs are good for you this decade. This is about watching the global financial system have what can only be described as a complete nervous breakdown in real time, and if you're not paying attention, you're going to wake up tomorrow wondering why your dollar suddenly buys half of what it bought yesterday. I'm William Lee, and it's Monday, January 19th, 2026, and for the last 48 hours, I've been watching something unfold in the silver market that's going to make that time. Your neighbor Bob tried to day trade crypto, looked like a sensible financial decision. Right now, as I'm recording this and you're listening, probably wondering if you remembered to take your medications this morning, silver is trading at approximately $94 to $95 per ounce. Now, I know what you're thinking. William, that sounds like a lot of money for something that used to be in my grandmother's cutlery drawer. And you're right, but here's the thing. This isn't just another rally where the price goes up for a few days and then crashes back down faster than your enthusiasm for your New Year's diet. What we're witnessing is the complete and total breakdown of how silver moves around the world. And that $95 price you're seeing is just the opening act of a show that's about to get very interesting. Let me start with what happened in the last 24 hours, because this is absolutely critical and also kind of hilarious in a dark, we're all doomed, but at least it's entertaining sort of way. When the futures markets opened Sunday night, because yes, markets trade on Sunday nights now because apparently nobody sleeps anymore, we didn't see a gradual climb like a sensible person walking upstairs. We saw what can only be described as a rocket launch. Silver blasted through every resistance level that so-called experts said would take weeks to breach, and it did so with the kind of violence and speed typically reserved for teenagers leaving the house when you ask them to help with yard work. The price didn't just gap up and then pause to catch its breath like a normal person would after climbing a flight of stairs at our age. It kept climbing. It liquidated every single bearish position that was sitting below the current price levels, which in plain English means it destroyed everyone who was betting that silver would go down. These traders got what we call in the business margin calls, which is a fancy way of saying their broker called them and said, "Give us more money or we're closing your position and you're going to lose everything," which is roughly as pleasant as your dentist calling to say you need a root canal. What we're seeing right now is what I call a liquidation cascade combined with an unstoppable bullish trend, which sounds very impressive and technical, but really just means that everyone who bet wrong is getting steamrolled and there's nothing they can do about it. Think of it like this. Imagine you're standing at the bottom of a hill watching a massive boulder at the top. For years, that boulder has been held in place by ropes and stakes, kind of like how you've been holding in your opinions at family dinners for the sake of peace. Those ropes represent all the mechanisms that banks have used to keep silver prices down. Well, yesterday someone cut the ropes, and now that boulder is rolling downhill, picking up speed, and heading straight for everyone who thought it would never move. The bearish positions below the current price are gone, liquidated, wiped out, destroyed more thoroughly than your kitchen after your grandchildren visit. The traders who were betting on silver falling back to $85 or $80 got forced out of their positions faster than you can say, "I told you to diversify your portfolio, but you wouldn't listen." And when they got forced out, they had to buy back their positions, which pushed the price even higher, which triggered more margin calls, which forced more buying. It's a self-reinforcing cycle, like eating potato chips, except instead of gaining weight, you're gaining catastrophic financial losses. But before we talk about where this rocket ship is heading, I need to take you back 24 hours to explain exactly how we got here. Because what happened over this weekend is not just a price movement. It's a fundamental restructuring of how silver flows around the world. And if you don't understand the mechanics, which most people don't, including your financial advisor who's probably as confused as you are about how smartphones work, you're going to be caught completely off guard by what happens next. Let me paint you the picture of what Sunday looked like. While most sensible people were enjoying their weekend, maybe doing something relaxing like yelling at the television during a football game or trying to remember where they put their reading glasses, something happened that changed everything. President Trump announced a 10% tariff on imports from 8 European nations plus the United Kingdom starting February 1st. That's less than 2 weeks away, which is barely enough time to finish the leftovers in your refrigerator, let alone prepare for a global financial restructuring. Now, buried in that announcement was a sentence that most people completely glossed over, but that sent the risk managers at every major bullion bank into absolute panic mode. The kind of panic you experience when you realize you've been talking for 10 minutes with something stuck in your teeth and nobody told you. The United Kingdom is on that tariff list, and the United Kingdom is home to something called the LBMA, the London Bullion Market Association, which is the single most important physical silver trading hub on the planet outside of New York. It's basically the Walmart of silver trading, except instead of cheap t-shirts and questionable produce, they're moving billions of dollars in precious metals. Let me explain what this means in practical terms, because this is where most people's eyes glaze over faster than when their kids try to explain Bitcoin. Imagine you have two water tanks. One tank is in New York and it's currently full of water. The other tank is in London and it's almost completely empty, like your patience when someone takes too long at the ATM. Under normal circumstances, this wouldn't be a problem. You just connect a pipe between the two tanks and the water would flow from the full tank to the empty tank until they balanced out, much like how money flows out of your bank account toward things you don't really need but bought anyway. That's how the global silver market has worked for decades. When London runs short of physical silver, which has been happening with increasing frequency because apparently India and China understand wealth preservation better than we do, which is somewhat embarrassing, the bullion banks simply move silver from the COMEX vaults in New York to the LBMA vaults in London. They put the metal on planes, they fly it across the Atlantic. Problem solved, the tanks stay balanced, the market stays liquid, everyone's happy, or at least as happy as bankers ever get, which isn't very. But here's what just changed, and this is where it gets both complicated and absurdly simple at the same time. President Trump just put a 10% tax on the pipe connecting those two tanks. And if a deal on Greenland isn't reached, yes, this is all connected to trying to buy Greenland, which sounds like something from a comedy sketch, but is somehow our actual reality, that tax jumps to 25% on June 1st. Now, you might be thinking, okay, William, so they pay a 10% tax, big deal. I pay sales tax every time I buy groceries, and half of what I'm buying I don't even need. But that's not how this works, and this is where the trap snaps shut like a mousetrap that's been waiting patiently for weeks. If a bullion bank ships silver from New York to London right now, they can do that without paying an export tax. The silver leaves the United States freely, waving goodbye, probably feeling pretty good about itself. But here's the catch, the hook. The absolutely devastating detail that makes this whole situation perfect. When they need to bring that silver back to New York later, which they absolutely will need to do because the COMEX also has delivery obligations and bills to pay. They have to pay a 10% tariff on the value of that metal when it comes back into the United States. Let me give you a concrete example so you can see exactly how devastating this is. And I promise this will be clearer than the instructions for assembling furniture from that Swedish store. Let's say silver is trading at $90 per ounce, which is approximately what it costs now, give or take. A bullion bank needs to ship 1 million ounces from New York to London to cover a short position, which is banker speak for, we promised someone silver we didn't actually have. That's $90 million worth of silver, which is more money than most of us will see in several lifetimes, even if we live to be 120. They ship it, no problem. The metal arrives in London. They've solved their immediate crisis, much like how you solve problems by pushing them off until tomorrow and hoping they magically resolve themselves. But 3 months later, the COMEX runs short, and they need to bring that million ounces back to New York. Now, when that silver crosses back into the United States, they have to pay a 10% tariff. At $90 per ounce, that's $9 per ounce, which means they're paying $9 million in taxes just to get their own metal back. It's like loaning your lawnmower to your neighbor and having to pay him 10% of its value just to get it back, except the lawnmower is worth $90 million, and your neighbor is the United States government. And if the tariff escalates to 25%, because we still haven't figured out this whole Greenland situation, they're paying $22.50 per ounce, which is $22.5 million on that same shipment. In the razor-thin margin world of bullion banking, where profits are measured in pennies per ounce, literally pennies, like the ones you probably have rolling around in your car that you can't be bothered to pick up, paying $9 or $22.50 per ounce in tariffs doesn't just hurt. It makes the entire operation economically impossible. It's financial suicide, which is generally considered bad for business and even worse for your performance review. So what do the banks do? They stop moving the metal, they trap it in place like a bug in amber. They refuse to ship silver from New York to London because they know they can never economically bring it back without losing their shirts. And bankers are quite attached to their shirts, especially the expensive ones. This is what I call the Roach Motel effect, and if you're old enough to remember those commercials, you know the slogan, "Roaches check in, but they don't check out." Well, that's exactly what the United States bullion market has become. Silver checks into the US, but it doesn't check out. It's Hotel California for precious metals, except the guitars are less soothing and more ominous. And this creates a catastrophic problem for the global silver market because London is now completely cut off from the single largest source of available physical silver. It's like being stranded on a desert island, except the island is one of the world's most important financial centers, and instead of water, they're running out of shiny metal that industry desperately needs to function. I want you to drop a comment below and tell me if you think this situation sounds completely insane, because from where I'm sitting, watching global finance collapse over an argument about buying an ice-covered island that most people couldn't find on a map feels like we've entered some kind of alternate reality where nothing makes sense anymore. Now, here's where this gets really interesting, and by interesting, I mean so ironic, it's almost poetic. In the first quarter of 2025, that's last year for those of you who, like me, sometimes forget what year it is, we saw one of the largest movements of silver from London to New York in modern history. Dozens of millions of ounces flowed out of LBMA vaults and into COMEX warehouses like salmon swimming upstream, except instead of trying to spawn, they were trying to avoid tariffs. And at the time, people thought the banks were being smart. They thought the banks were cleverly front-running government policy. Everyone knew that silver is a strategic mineral. It's used in everything from solar panels to missile guidance systems to that new phone you bought that does exactly the same things as your old phone but costs twice as much. Everyone knew that import restrictions were possible, so the banks did what they thought was the smart thing. They moved their silver into the United States ahead of time to avoid getting caught on the wrong side of import tariffs. They were being proactive, which is generally considered a good trait, like flossing regularly or actually reading the terms and conditions before clicking, I agree. But here's the beautiful irony that makes this entire situation so perfect, it's almost like watching a comedy where everything goes wrong in the most predictable way possible. The banks assumed the tariffs would restrict imports into the United States. They moved the metal into U.S. vaults thinking they were protecting it like a squirrel storing nuts for winter, but they completely miscalculated. They got it backwards. The tariff doesn't restrict imports. It restricts exports. Or more accurately, it makes exports economically suicidal because you can never bring the metal back without taking a massive loss that would make your worst investment decision look brilliant by comparison. So the banks, in their attempt to be clever, in their attempt to outsmart the government, which, let's be honest, is usually not that difficult, but apparently this time was, literally trapped themselves. They moved millions of ounces of silver into a cage and then locked the door from the inside. It's like a bank robber who breaks into a vault, stuffs his bag with money, and then realizes the only way out is through a door that costs him 25% of everything he's carrying to open. He's rich inside the vault and broke if he tries to leave. It's the kind of mistake that gets talked about in business schools for decades, assuming business schools survive long enough to tell the story. And this brings us to what's happening right now today, Monday, January 19th, 2026, as silver trades at $94 to $95 and continues to climb faster than your blood pressure when you see the bill at the doctor's office. The market is starting to wake up to the reality of the trap, like a cartoon character who runs off a cliff and hangs in midair for a moment before looking down and realizing there's no ground beneath them. Let me walk you through what happened overnight and why this momentum is so unstoppable. It makes a freight train look like it's standing still. When the futures markets opened Sunday night, the first thing that happened was what we call a gap up, which sounds technical but really just means the price jumped dramatically. Silver didn't open at Friday's closing price like a polite guest arriving on time. It opened significantly higher, like that relative who shows up early to Thanksgiving and starts criticizing your cooking before you've even finished preparing it. And that gap immediately triggered stop losses on bearish positions, which are basically automatic, get me out of this trade before I lose everything orders that traders set up because they're not completely stupid, just mostly stupid. Traders who were betting on silver going down had these stop loss orders sitting at certain price levels. When those levels got hit, their positions automatically closed, which meant they had to buy back their short contracts, which pushed the price higher, which hit more stop losses, which triggered more automatic buying. It's like dominoes, except each domino is worth millions of dollars. And when they fall, they destroy people's retirement accounts. This is what's called a short squeeze, and it's a self-reinforcing mechanism more reliable than your coffee maker that's been working since 1987 and refuses to die. But here's what makes this particular squeeze different from every other squeeze we've seen in the last decade, and I've seen a lot of squeezes, both in markets and in trying to fit into pants I bought 5 years ago. In previous squeezes, the banks had escape hatches. They had tools. They could move physical metal from London to New York to meet delivery demands. They could lease silver from central banks, who apparently have nothing better to do than help bullion banks out of tight spots. They could shuffle inventory around the global system to wherever the pressure was building, like moving furniture around a room to make it look different, even though it's the same furniture. This time, all of those escape hatches are sealed shut tighter than the jars in your pantry that you can't open anymore and have to ask someone younger to help with, which is humiliating but necessary. The tariff has eliminated their geographic flexibility. They can't move metal from New York to London without trapping it there permanently. They can't rebalance their global positions without taking catastrophic losses. And so the squeeze just keeps building pressure with no release valve, like a pressure cooker that's about to become a very expensive science experiment. Think of it exactly like a pressure cooker, since we're already on that metaphor. Normally, when pressure builds up inside one of those things, there's a little valve on top that releases steam. As long as that valve is working, the pressure never gets dangerous. You can cook your pot roast or whatever people cook in pressure cookers these days without fear of explosion. But what happens if you weld that valve shut? If you eliminate the safety mechanism, the pressure keeps building and building and building, and eventually something has to give. The pot explodes. Food goes everywhere. Your kitchen looks like a crime scene. Your spouse asks what you were thinking. You have no good answer. That's what we're watching right now in the silver market. The pressure is building. The bearish positions below $95 have been liquidated like yesterday's leftovers that you finally threw out after they'd been in the fridge too long. And the next layer of resistance is sitting at $100. Once we break through 100, and I believe we will break through 100 this week, possibly in the next 48 hours, which is less time than it takes you to finish your to-do list that's been on your refrigerator for 6 months, we're going to see another massive wave of liquidations because there are a lot of traders who have short positions with stop losses sitting right above the $100 level. They put their stops there because $100 is a psychological barrier. It's a big round number. It's a level that silver hasn't traded at in modern history, kind of like how your cholesterol level probably hasn't been at recommended levels since the Reagan administration. And these traders thought, silver will never actually get to 100, so my stop is safe there, much like how I'll definitely start exercising next week. Well, they're about to learn a very expensive lesson about underestimating the power of a supply chain disruption combined with a technical short squeeze. It's the kind of lesson that costs millions of dollars and makes you question all your life choices. Now let me explain why this bullish trend is not just strong but inevitable. And I'm using that word very deliberately. Inevitable. Not probable, not likely. Inevitable, like death and taxes and your computer updating at the exact moment you need to use it urgently. The fundamental driver of this move is not sentiment, it's not speculation, it's not retail investors piling into the market hoping to make a quick profit like they did with GameStop, before realizing they had no idea what they were doing. The fundamental driver is a structural impossibility in the global supply chain, which is a fancy way of saying the system is broken in a way that can't be easily fixed. London needs physical silver. They have contracts that require delivery, like promises you made to yourself about eating healthier that you actually have to keep this time. They have industrial buyers who need metal to manufacture things. They have ETFs that have promised their shareholders physical backing, and the only place they can get that silver in the quantities they need is from the COMEX vaults in New York. But, and this is the critical part, the COMEX silver is trapped by the tariff. It cannot economically flow to London. It's stuck. Immobilized, going nowhere faster than your motivation on a Monday morning. So what happens when you need something desperately but can't get it from the usual supplier? You have to pay more, a lot more. London has to bid up the price to incentivize existing holders in London to sell. They have to offer $100, $110, $120 per ounce to get people to part with their physical metal. And as the London price rises, it pulls the New York price up with it, because even though the metal can't physically flow between the cities due to the tariff, the price discovery mechanism still links the two markets like conjoined twins who share a bank account. This creates what I call a price discovery cascade, which sounds very scientific and important. The market is searching for the price level where supply and demand actually balance, like trying to find the perfect temperature in the shower where it's not too hot and not too cold. And because the supply is trapped, because the normal flow mechanisms are broken, that price level is much, much higher than where we are right now. Let me give you an analogy that will make this crystal clear, assuming my analogies ever make anything clear, which is debatable. Imagine you live in a town with two grocery stores, Store A on the north side of town and Store B on the south side. Normally, if Store A runs out of bread, the manager just calls the distributor and says, "Send me more bread from the warehouse." And the bread shows up the next day. Easy. Simple. The price of bread stays stable at $3 a loaf or whatever bread costs these days, because honestly I haven't checked in a while and everything seems more expensive than it used to be. But now imagine that the government, in its infinite wisdom, builds a wall right down the middle of town. And they put a 25% tax on any bread that crosses that wall, because apparently we're living in some kind of dystopian novel now. Store A on the north side runs out of bread, but the warehouse is on the south side. To get bread delivered, Store A has to pay the normal price plus a 25% tax. That makes the bread economically unviable. Store A can't sell bread at a profit anymore if they have to pay that tax. They'd be losing money on every loaf, which is generally considered poor business practice. So what happens? Store A just stops ordering bread from the south side. They say, forget it, we're out of the bread business until this nonsense gets resolved. And the people on the north side who need bread suddenly realize that there's no supply coming. So they start bidding against each other like at an auction, where everyone wants the same antique vase, except the vase is bread, and everyone actually needs it to make sandwiches. They offer $5 for a loaf, then $7, then $10. The price keeps going up until it reaches a level where someone who currently has bread is willing to sell it, which at some point becomes ridiculous, but that's economics for you. Meanwhile, on the south side of town, bread is still $3 a loaf because the warehouse is right there. You've got the same product trading at two completely different prices in the same town, separated by a wall and a tax. It's absurd. It violates everything you learned in Economics 101, assuming you took Economics 101, which you probably didn't because you were busy taking classes that seemed more practical at the time. That's exactly what's happening in the global silver market right now. New York is the south side with the warehouse. London is the north side that's running out of bread. And the tariff is the wall in the middle that some bureaucrat thought was a good idea. And here's the critical point that I need you to understand because I'm going to be asking about this later. This isn't a situation that resolves itself quickly. This isn't a temporary dislocation that the market can arbitrage away in a few days, like that time you accidentally bought two of the same book because you forgot you already owned it. This is a structural change that persists as long as the tariff persists. And the tariff is contingent on Greenland negotiations, which, let me be very clear about this, are not going well. They're going about as well as your last attempt to explain to your grandchildren why you don't understand their text message abbreviations. I've been reading everything I can find about the Greenland situation. I've been following statements from Danish officials who sound very annoyed, from Greenlandic politicians who sound confused, and from US negotiators who sound like they're not entirely sure how this became their job. And the odds of a comprehensive deal being reached by June 1st, when the tariff escalates from 10% to 25%, are extremely low. I'd put them at less than 30%, which is about the same odds of you actually using that gym membership you bought in January. Why? Because this isn't just a real estate transaction where you negotiate a price and sign some papers. This is a sovereignty issue. It's about identity and politics and all those messy human things that can't be solved with a calculator. Greenland is not a piece of property that Denmark can just sell like a used car. It's a territory with its own political identity, its own cultural significance, its own population of people who have opinions about their future and don't particularly appreciate being discussed like a commodity. The Danish government is facing enormous political pressure not to sell. There are constituencies in Denmark that view selling Greenland as a betrayal of Danish heritage, which I suppose is understandable when you consider they've held it since 1814, which is longer than most marriages last these days. There are Greenlanders who view any sale as colonialism, which is also a fair point given the history of colonialism. And there's the broader European Union, which sees U.S. control of Greenland as a fundamental shift in the balance of power in the Arctic region, which apparently matters a lot even though most of us can't find the Arctic on a map. From the European perspective, they can just wait this out. They can absorb the economic pain of the tariffs. They can hope for a change in U.S. policy after the next election, which is always a possibility in our delightfully chaotic political system. They're playing a long game. The U.S. is playing a short game. And when you have that kind of mismatch in time horizons, when one side is thinking in terms of decades and the other is thinking in terms of quarters, deals don't get done quickly. They get dragged out longer than a family dinner where someone brings up politics. So what does that mean for silver? It means the tariff is likely here to stay for months, possibly years. It means the geographic arbitrage trap is not a temporary phenomenon that will resolve itself next week. It means the separation between London prices and New York prices is going to widen, not narrow. And it means that physical silver holders, people who own actual metal that they can touch with their actual hands, are sitting on an asset that is becoming more valuable every single day like a fine wine, except you can't drink it and it's much heavier. Now, I want to hear from you in the comments. Tell me, do you own physical silver right now? Are you thinking about buying some? Are you sitting there thinking, William, you sound insane, and I'm going to ignore everything you just said? Whatever you're thinking, drop a comment below because I read every single one of them, and your opinions matter even if they're wrong, which statistically speaking, some of them will be. Let me talk about what I'm watching in the next 48 to 72 hours, because this is where things could get really explosive, like that time you tried to pressure cook something you shouldn't have. There are 3 key triggers that I'm monitoring closely, and any one of them could send silver significantly higher in a very short period of time, possibly while you're sleeping because markets are inconsiderate like that. Trigger number 1 is the $100 breakout. Right now, silver is trading at $94 to $95. We're only $5 or $6 away from 100. That's a 5% move, which in normal times might take weeks to happen. But we're not in normal times. We're in times where a dispute about buying Greenland is affecting global commodity markets, which should tell you everything you need to know about how weird things have gotten. In a market that's already in a short squeeze with momentum this strong, we could see that 5% move in a single trading session, possibly in a single hour if things get really crazy. And when we break 100, when silver trades with a 1 and 2 zeros in front of it for the first time in modern history, the psychological impact is going to be enormous. It'll be like when gas prices first hit $4 a gallon and everyone lost their minds, even though we all knew it was inevitable. Retail investors who have been sitting on the sidelines are going to pile in. Hedge funds are going to start talking about silver on CNBC between their usual programming of people yelling about stocks nobody's heard of. Social media is going to explode with rocket ship emojis and to the moon posts from people who probably also invested in cryptocurrency during the peak and lost money. And all of that attention is going to drive even more buying, which is going to push the price even higher. The $100 level is not just a technical resistance level. It's a psychological trigger that's going to unleash a wave of FOMO, fear of missing out, buying from people who normally wouldn't touch commodities with a 10-foot pole. Trigger number 2 is margin hikes on the COMEX. When exchanges see volatility spiking, when they start getting nervous like a parent watching their teenager learn to drive, they raise margin requirements to force speculators out of the market. It's a standard risk management procedure. But here's what most people don't understand. Margin hikes are also a signal. They're like when your doctor starts hemming and hawing before giving you test results. They're a sign that something is wrong. They're a signal that the exchange is worried about their ability to meet delivery obligations, which is exactly as bad as it sounds. If I see a margin hike of 20% or more this week, I'm going to interpret that as confirmation that the COMEX is genuinely concerned. And when the COMEX is concerned, when the people who run the exchange are worried, that's when you know this isn't just a speculative rally that's going to fizzle out like your enthusiasm for that project you started in the garage and never finished. That's when you know we're in a genuine supply crisis. The kind that gets written about in history books and studied by future economics students who will wonder how we let things get this bad. Trigger number 3 is the London-New York spread. This is the nuclear option indicator, the one that tells you the whole system is breaking down. Right now, silver trades at roughly the same price in London and New York because arbitrage keeps the two markets in sync like synchronized swimmers who actually know what they're doing. But if the spread between those two prices hits 5% or more, it means arbitrage has completely broken down. It means the tariff has created a permanent barrier to the normal flow of metal, and it means we're entering uncharted territory, like Columbus, except instead of discovering America, we're discovering that our financial system is held together with bubblegum and optimism. A 5% spread would mean that if silver is trading at $100 in New York, it's trading at $105 or more in London. That's a $5 difference on a $100 asset, which is enormous for a commodity market. It's like if gas at the station on one corner cost $4 and gas at the station across the street cost $4.20, except multiplied by billions of dollars. And if we see that kind of spread develop and persist for more than a day or two, it's a signal that the system is fracturing like ice on a pond that you really shouldn't be walking on, but you're going to anyway because you never listen to warnings. Now let me address something that I know is on a lot of people's minds, assuming you're still with me and haven't wandered off to do something more productive. What about a pullback? What about profit taking? What about the banks trying to smash the price back down like they've done so many times before? Kind of like how you keep trying to fix that one thing in your house that keeps breaking no matter how many times you fix it. Here's my view, and I've been wrong before, so take this with a grain of salt, or several grains, because honestly, salt is good for you in moderation. Yes, we could see a dip. We could see profit taking push silver back to $90 or even $88, but I don't see it going below that, and I'll tell you why. The physical demand is too strong. The industrial buyers are too active, and most importantly, the large holders of physical silver are not selling, which is telling you something important if you're paying attention. Think about it from the perspective of someone who owns 100,000 ounces of physical silver. You've been holding this metal for years, maybe decades, watching the price get suppressed like a beach ball being held underwater. You've watched rally after rally get smashed back down by the banks. You've listened to analysts tell you that silver was going nowhere. You've endured family members asking why you own so much of something that doesn't pay dividends and just sits there taking up space in your safe. And now, finally, you're seeing the beginning of what you've been waiting for. You're seeing the supply chain crack. You're seeing the shorts get squeezed. You're seeing momentum build like a snowball rolling downhill. Are you going to sell at $95? Are you going to take your profit and walk away right before the big move, like leaving a party right before they bring out the cake? Of course not. You're going to hold. You're going to wait for 100. Then you're going to wait for 110, then 120. You're going to hold because you understand that what's happening right now is not a normal rally. It's a structural break in the market, and structural breaks don't resolve themselves at $95. The large physical holders are the smart money in this market. They're the ones who understand the supply dynamics better than your financial advisor understands anything, frankly. They're the ones who have been accumulating for years at low prices while everyone else was buying stocks that went up and then crashed. and they're not selling. And as long as they're not selling, there's a floor under the price, like the floor under your feet, except more metaphorical and financially significant. Could the banks try to smash it down with paper shorts? Sure, they might try. They've tried before. But here's the thing that makes this time different, which I know is the most dangerous phrase in finance, but bear with me. Every ounce of paper silver they short creates another liability that they eventually have to cover. And in a market where physical supply is trapped and unable to flow freely like water through a clogged drain, shorting paper silver is like digging yourself into a deeper hole while insisting you're actually building a ladder. It might work for a day or two. You might even convince yourself it's working. But ultimately, it just makes the squeeze worse when you have to buy back those shorts. Kind of like how ignoring a problem doesn't make it go away, it just makes it worse when you finally have to deal with it. Let me share with you my personal framework for navigating the next 2 weeks, because I think these next 14 days are going to be some of the most volatile and potentially profitable in the history of the silver market, which is saying something considering silver has been traded for thousands of years. First, I am holding my physical silver with absolutely no intention of selling. I don't care if silver hits $100. I don't care if it hits 110 or 120. The metal stays in the safe, locked up tighter than the jar of pickles I can't open anymore. Why? Because I understand that what's happening right now is bigger than a short-term price move. This is a fundamental restructuring of the global silver market. This is the breakdown of the suppression mechanism that's kept prices artificially low for decades, like finding out the scale you've been using has been broken this whole time, and you actually weigh 10 pounds more than you thought. Except in this case, it's the opposite, and things are finally being valued correctly. Second, I am ignoring the spot price that you see on financial news networks, those numbers that scroll across the bottom of the screen while talking heads discuss things they don't fully understand. That spot price is an average of paper prices across multiple exchanges. It's a mathematical construct that doesn't reflect the reality of what it actually costs to get your hands on physical silver right now. If you call a dealer today and try to buy 1,000 ounces of physical silver, which you probably shouldn't do without consulting your spouse and possibly a therapist, you're not paying $95 per ounce. You're paying $95 plus a premium that has been widening dramatically. I've been talking to dealers, I've been watching the spreads like a hawk watches a field mouse, and what I'm seeing is premiums that are 15, 20, sometimes 25% over spot for immediate delivery of physical metal. That means the real price of physical silver, the price you actually have to pay to get metal in your hand right now, is already well above $100. The spot price just hasn't caught up yet, like how your understanding of technology always lags about 5 years behind where it actually is. Third, I am watching for any headlines out of Greenland or Denmark that indicate the negotiations are stalling, which, given how negotiations usually go, should be most headlines. Every day that passes without progress on a Greenland deal is another day closer to February 1st, when the 10% tariff kicks in like a headache you know is coming but can't prevent. And every day after June 1st without a deal is another day under the 25% tariff regime, which at that point is just rubbing salt in the wound. Fourth, and this is important, I am prepared for increased volatility. We could see days where silver moves 5 or 10% in a single session. We could see massive gaps up or down that make your stomach drop, like when you miss a step going downstairs. We could see trading halts. We could see margin hikes that trigger cascading liquidations. This is not going to be a smooth, orderly move higher like a nice leisurely walk in the park. This is going to be chaotic. It's going to be violent. It's going to shake out weak hands faster than a paint mixer shakes paint. And if you're not prepared for that volatility, if you're not comfortable with massive swings in value that would give most people heart palpitations, then you probably shouldn't be playing this game right now. Fifth, and this is absolutely critical, I am focused on the physical market, not the paper market. I'm not trading futures. I'm not buying options. I'm not using leverage, which is what people use when they want to either make a fortune or lose everything. And it's usually the latter. I own physical metal, and I'm holding physical metal. Why? Because when the system breaks, when we hit what they call a force majeure event, which is French for everything went wrong and nobody knows what to do, when exchanges can't meet their delivery obligations, the only thing that's going to matter is whether you own actual silver or whether you own a paper claim on silver that may or may not be honored, like an expired coupon that the store refuses to accept. Now let me talk about what the banks are really afraid of, because this is something that doesn't get discussed enough anywhere, let alone at dinner parties where people would rather discuss literally anything else. The banks are not afraid of high silver prices per se. They've navigated high prices before. They're smart people with expensive educations and even more expensive suits. They can hedge. They can adjust their books. They can do all sorts of financial gymnastics that would make your accountant dizzy. What they're afraid of is a market where they can't move metal to where they need it, which is exactly the situation they're in right now. The entire fractional reserve system in precious metals, the system that allows the banks to sell more silver than actually exists, which when you think about it is kind of insane but somehow legal, depends on geographic flexibility. It depends on the ability to shuffle metal around the world to wherever the pressure is building, like moving sandbags around during a flood. When London gets tight, metal flows from New York. When New York gets tight, metal flows from Zurich or Singapore or Hong Kong. It's a global shell game, and it only works as long as the shells can move freely like pieces on a game board. But the tariff has locked down one of the major shells. New York can't ship to London anymore without taking a catastrophic loss that would make even the most risk-tolerant banker weep into their overpriced whiskey. And that breaks the entire game. The banks can't play whack-a-mole with physical shortages anymore. They can't suppress prices by moving metal around like furniture. They're trapped like rats in a maze, except the rats have MBAs and the maze is made of tariffs. Think of it exactly like a bank run, which we all remember from history class or from watching movies about the Great Depression. A traditional bank might only keep 10% of deposits in the vault. The other 90% is loaned out, invested, used to make more money because that's how banking works. As long as everyone doesn't ask for their money at the same time, the system works fine. It's been working fine for centuries, but what happens if everyone shows up at once demanding their deposits in cash? The bank collapses because they don't actually have the money. They have loans and investments and promissory notes, but they don't have actual cash sitting in the vault. That's what's happening in the silver market right now. The LBMA has made promises to deliver physical silver. They've sold contracts. They've backed ETFs. They've created paper claims on silver that all seem very official and legitimate. And they did all of this based on the assumption that if they ever needed physical metal in a hurry, they could just call their friends in New York and have it shipped over on the next flight, no problem. But now they can't call New York. The phone line has been cut by a 25% tariff that makes the call too expensive to justify. And all of those paper promises, all of those delivery obligations are coming due at the same time, like all your bills arriving on the same day. And the vault is empty, or at least emptier than anyone wants to admit. The LBMA is facing a bank run in slow motion, and there's nothing they can do to stop it, except hope that somehow this resolves itself, which is about as effective a strategy as hoping your check engine light goes away if you just ignore it long enough. This is why I believe, and I'm putting my reputation on this, whatever that's worth, we're going to see silver trade above $100 this week, not because of investment demand from retail investors who suddenly care about silver, not because of inflation fears, though those are valid, not because of dollar weakness, though that's also happening, but because the LBMA is going to have to bid up the price to astronomical levels to incentivize existing holders in London to sell their physical metal. They have no other choice. They're trapped in a corner like a cat that climbed too high in a tree, and the only way out is to pay up. And here's the beautiful part, the cherry on top of this chaos sundae. As the London price goes up, it pulls the New York price up with it. Even though the metal can't physically flow from New York to London because of the tariff, the price discovery mechanism still links the two markets like two people in a three-legged race. Traders see silver at 110 in London and 95 in New York, and they start buying New York contracts hoping to capture that spread somehow. And that buying pressure pushes the New York price higher, even though the physical arbitrage can't actually happen. So we get price convergence without physical convergence, which sounds like something from a physics textbook, but is actually just markets being weird. The prices move closer together even though the metal can't move. And that's how we end up with silver at $100, $110, $120 or higher across both markets simultaneously, which is going to make a lot of people very rich and a lot of other people very poor, depending on which side of the trade they're on. This is William Lee, still trying to explain complicated financial concepts to people who probably just wanted a simple yes or no answer. We are living through one of the most extraordinary moments in the history of precious metals markets, and I'm not being hyperbolic when I say that. We are watching the real-time breakdown of a suppression mechanism that has been in place for decades, longer than some of you have been married. We are watching geographic barriers create pricing anomalies that shouldn't exist in a modern, globalized market where everything is supposed to flow freely. We are watching the laws of supply and demand reassert themselves in a commodity that has been manipulated and controlled for far too long. Silver at $94 today is not expensive when you understand what's really happening. Silver at $100 is not expensive. Silver at $120 is not expensive when you grasp the structural impossibility of the current supply chain. The tariff has created a trap. The banks walked into that trap thinking they were being clever, and now they're paying the price, literally and figuratively. If you own physical silver, hold it like you hold on to grudges, which is to say tightly and for a long time. If you've been thinking about buying physical silver, understand that the premiums you're seeing today are likely the cheapest premiums you're going to see for a very long time, possibly ever. And if you're trading paper silver, understand the risks you're taking like you understand the risks of not reading the terms and conditions before agreeing to something online. The 14-day countdown to February 1st has begun, ticking away like a timer on a game show, except instead of winning a prize, you're watching a global market restructure itself. The tariff is coming, the trap is closing, and silver is going higher because mathematics and logistics and reality eventually win out over manipulation and promises. Stay sharp out there, watch the data, trust the fundamentals, and for goodness sake, drop a comment below telling me what you think about all this, because I genuinely want to know if anyone made it this far or if you all gave up halfway through and went to make a sandwich.